Thanks everybody for joining. Really appreciate everyone taking the time, and welcome to our webinar today on multi-currency in NetSuite, demystifying the process. My name is Scott Grillo. I am the Services General Manager at Charted. Charted here is a full-service NetSuite provider, an alliance partner, and an SDN partner. Essentially, we help companies implement, optimize, and support NetSuite. I have over 16 years of experience with NetSuite, helping organizations evaluate NetSuite, plan projects, implement NetSuite, and then support their environment long-term. And I'm joined today by our resident multi-currency expert, Peggy Eveleth. Peggy, you want to introduce yourself?
Sure. Hi, I'm Peggy Eveleth. I have been in the NetSuite space almost 10 years now. Prior to that, I was an ERP consultant with other software, but I started my career as an accountant. My specialty in accounting has always been foreign currency accounting and foreign consolidations. I was a global controller prior to coming over to the NetSuite space, and I still focus a lot on international implementations, foreign currency, consolidations, intercompany, and basically anything related to global NetSuite implementations and global practices.
Awesome. Well, we've got a fun-filled agenda today, and I want to set everyone's expectations. This is not a high-level overview. This is not a sales presentation or a pitch. This webinar is for what we call practitioners, folks that are NetSuite administrators or individuals who are just in the system day to day, and they're trying to get information on how NetSuite works and how they can make it work for their business. So we're going to get into details. We're going to get into some key concepts, talk about NetSuite features, talk about configuration options, and we'll have some fun along the way. The agenda for today is we'll start out with some basics around terminology, really set the groundwork there. We'll then get into some key features for handling foreign exchange. We'll talk about exchange rates, foreign transactions, and how this all comes together with consolidations. We do have time at the end blocked out for Q&A, but please ask questions as we go. We'll do live question and answer. So ask, we'll answer. Please direct your questions to the Q&A section within Zoom, and we'll address those in real time. With that being said, Peggy, I will pass to you to get into it.
All right. So just a brief note about terminology and why I'm spending time with terminology. The terminology is very specific when it comes to foreign currency accounting, and understanding the terminology is key to actually understanding how NetSuite works, how it should be working, and why it's important. The first and foremost, functional currency. NetSuite calls it base currency. It's the currency that your subsidiary is denominated in. This is an extremely important concept. This is an important concept because it directly affects decisions around how you set up NetSuite, and more importantly, how transactions are processed. One of the things that I'm seeing right now is that auditors are becoming more and more focused on what the correct functional currency for an entity is. That becomes important. ASC 830, which you'll hear me talk about ASC 830 a lot during this presentation. ASC 830 has guidelines for determining what your local what your functional currency should be. Fun fact, it's not always the local currency, and that is extremely important to understand. It's very important that you know for certain under ASC 830 what your functional currency should be. When you set up a new subsidiary, you select that functional currency at that time. If you do not select it correctly, it has implications down the line. So you want to make sure you absolutely understand what that functional currency is. In many cases, the functional currency will be the local currency, at which point you're relying on NetSuite to go in and translate that information for consolidation. However, in an increasing number of cases, the functional currency may be the parent's currency. So that happens when the parent is really supplying the revenue stream, and basically So it's under a management fee or a transfer pricing type situation where there's not really an independent revenue stream. And a lot of the transactions are done in the parent currency, not in the local currency. So at that point, what you're finding is auditors are more and more expecting the parent currency to be the functional currency of the subsidiary. Now, why is that important? That is also important because your local country may not want your your statutory accounts and your statutory reports for them to be in that parent currency. They may well want it to be in the local currency. So if you are in Germany, for example, and your auditors have decided that for GAAP purposes, you should be in the functional currency, the parent currency, but the Germans want local currency and they want books that are natively in that currency, you might need full multi-book, which permits you to carry a statutory book in euros while maintaining a primary book in US dollars. So that becomes very important. Next slide, please. All right, so what are my different types of exchange differences? This one's also really important. You have differences that are transaction based and differences that are translation based. So the first two items here, the realized gain and loss and the unrealized gain or loss, are transaction based. So that basically means that I have exchange differences that are arising from transactions that I do in an entity that are in a currency that is not the entity's base currency or functional currency. So what does that really look like? I am a US dollar company. I receive an invoice from overseas that is denominated in euros. My vendor is expecting me to pay for that in euros. So when I book that transaction, it comes in, I book it in the in the currency, the system will translate it for me. And then when I pay it, it will calculate the difference between when it translated it and when I paid it. At the end of the month, if it's not paid, it's going to calculate the difference between when I booked it and the end of the month so that I can book that in as an unrealized gain or loss. So the realized gain or loss is what happens when I actually pay it. The unrealized is what happens at the end of the month when I am expected under ASC 830 to revalue it and calculate the unrealized gain or loss. The other translation types I have is I have a CTA, cumulative translation adjustment, and a CTAE, an elimination adjustment. CTA is what I see in the equity section of my balance sheet when I translate an entity that is not in my parent's reporting currency. So in real life language, that is what I get when I translate a euro based subsidiary into USD for consolidation. Now, what happens is because that consolidation happens at different rates for different balance sheet account types, I end up getting an inherent difference, and that goes in the equity section of the balance sheet under currency translation adjustment or CTA. The last one is when I do eliminations. There might be small differences when I eliminate. So what am I eliminating really quickly? I eliminate intercompany items. So I eliminate intercompany assets, intercompany liabilities, intercompany income, and intercompany expense. That's so that I don't gross up my income statement and my balance sheet. The balance sheet should eliminate almost to the penny. The income statement might have some small differences because of how things are translated at month end. However, the differences that go into the elimination entry should be very small. That CTAE happens in an elimination entity only. It does not happen within the entity itself, and that is a key difference between CTA and CTAE. CTA is an amount that you cannot effectively manage. It is what it is. However, it's in the equity section of the balance sheet, so people don't really worry about it much. CTAE, on the other hand, is basically an entry that happens when you're doing your elimination entry and you have an out of balance amount. I refer to CTAE as the canary in the coal mine. That's because if it's a small amount, I expect to see that small amount. If it's a large amount, your canary has died, and you need to be looking at why your intercompanies are out of balance. Any questions here on terminology at all?
Thank you. We don't have any yet, but I think as we get into it, we'll start to see some.
Okay. Sounds good. Next slide. This is just an example of what it looks like in NetSuite when you set up your functional currency. Note that it's highlighted in yellow. The currency is highlighted. Big caveat. If you have done it wrong and you have saved this, you can't go back and change it. You must delete the entity and start over. This becomes even more of a concern if you have transactions you've already put in there. As I talked about initially in the terminology section, that is why it is really important for you to get this right from the outset. If you are not sure, talk to your auditors. Make sure to get a pronouncement from them or an opinion from them. And it doesn't need to be a big, long statement. You just need to ask them what should the functional currency be when you set this up, because that way, once you're into it in the first year, you don't get them coming back and going, hey, you didn't do that right. And now you have to redo everything. You don't want that. You really don't want that. That important. Some more terminology basics of translation and remeasurement. Translation is the act of calculating the account values in the reporting currency for consolidation. So that means I'm taking my euro company and I'm translating it for consolidation purposes at month end. Now, it's important to note that the rate used to translate each account depends on what type of account it is. So for the income statement accounts are translated using an average rate at the end of the month. The balance sheet is used using the rate at the last day of the month, aka the reporting period. So if you're a 544 or whatever, it is the rate on the last day of that reporting period. I just generally tend to default and say month. However, some entities use a 544, so the month end may not be the calendar month end, but it is the rate at the end of the reporting period. The other last piece is for equity accounts, and that is using the rate at the point in time that the transaction is booked. And that transaction will never change rate. So most common, you don't see this very often, but you might see it with a common stock, an initial common stock entry, or APIC, additional paid in capital. So I'm an entity. I've been around for a couple of years. Parent entity is doing some additional capitalization. They're doing it in the month of March. So they're putting in $1 million USD, and that will calculate, say, at 850 euros. It goes in at 850 euros at that receiving entity, which is a euro-based company, but the rate is set to where it will always translate back to be €1 million forever and ever and ever, because APIC is an account that is translated at historical. Remeasurement. That's the value of the foreign denominated monetary assets, super important to highlight this, monetary assets and liabilities using the rate at the last day of the month. This is the unrealized gain or loss that you see coming in when you run the revaluation at the end of the month. This should be applied to monetary assets and liabilities only. Again, ASC 830, really clear, monetary assets and liabilities. So no, you're not revaluing fixed assets that you bought in a different currency. You're not revaluing prepaids. You're revaluing cash accounts that are not in your functional currency. You're revaluing AP and AR that's not in your functional currency. Again, monetary assets only. Next slide, please.
We have a couple questions,
Sure.
Peggy.
Yes.
Question number one is, how does one decide what accounts should be set up to remeasure?
Monetary. Okay, so what's a monetary account? Generally, I look at a monetary account as an account that has a full life cycle to it, or so AP or AR. So what happens with AP when I get an invoice in a currency that's not my functional currency? I pull it in at the rate of the day for the transaction. And then when I pay it, I'm going to pay it at either the rate of the day if I have the foreign currency account for that, a bank account for that currency, or if I don't and I'm relying on the bank to pay it in that foreign currency and then charge me, it's going to be the rate the bank charges me. So there's a complete life cycle of a transaction there. The other accounts that are pretty obviously monetary accounts are bank accounts. If I have a bank account that is not in my functional currency, I will need to revalue it every month. Other question?
One other question is, and you touched on this a little bit around functional currency, but how does NetSuite handle it if auditors require a change in functional currency?
It's ugly. You have to literally there are a couple ways to do it. It's ugly either way. Hopefully, by setting it up initially correctly, they're not going to come back and say, oh, you did it wrong. You need to do it differently. Clearing it up front is the best way to do it. However, sometimes businesses change, and what was originally an entity whose functional currency is the parent currency has established more boots on the ground, brick and mortar type environment, at which point the auditors may signal that you need to change, and you need to change at a specific date. Usually they will be kind enough to do that at a year end, at which point you need to set up a new entity. And the auditors will need to help you provide that opening balance sheet for the new entity in the new functional currency, which is the local currency in the example I'm giving. Keep in mind, it can go the other way as well. This doesn't happen a lot, but there can be trigger items such as a change in ownership of the parent entity that will engage the auditors to start looking at the functional currencies of any subsidiaries. The good news is there generally needs to be some sort of event, accounting event, that precipitates the auditors looking at this. They don't just sort of come along in any given year, or at least this has not been my experience, that they come along in any given year and go, oh, yeah, you need to change this. Usually there needs to be some sort of event that precipitates this change in what is basically an accounting policy. So they don't do it willy-nilly, but keep an eye out for a precipitating event potentially, and just get it done, do it right in the beginning for new entities.
All right.
Next slide, please. Okay, so all of this terminology stuff, I just spent 20 minutes talking about terminology. So for everybody who's still awake, how does NetSuite actually do this? And NetSuite, honestly, any of the mid-market ERPs out there, NetSuite does the best job that I've seen. A lot of the other stuff, the other competing softwares in this space that I've seen aren't as fully featured around actually addressing the issues and addressing them appropriately for ASC 830. So kudos to NetSuite on this. And now, yeah, how does it do it? First of all, automated exchange downloads and calculation of those monthly consolidated exchange rates. I've talked about, okay, so I get this invoice from, I have a vendor bill that's come in. I'm a US dollar company. It's come in euros, and I put it in at the rate of the day. So where does that rate of the day come from? It sounds so simple when I said, oh, just use the rate of the day. NetSuite has a function when you set up your currencies to download those rates on a daily basis. There are two sources for that. One's Xignite, the other is HSBC. You set it up and forget it, which is absolutely great. So it goes in, it downloads the rates on a daily basis. You can go back, you can look for those rates. They're in a table. And then at the end of the month, it's going to calculate the exchange rates for you for consolidation. So if you remember, I said that there are 3 rates that are in play for consolidation. There is the current rate, which is the rate on the last day of the reporting period. Like I said, I'm going to say month a lot. It's the last day of the month. You have the average rate. Now, what NetSuite does is it calculates a weighted average rate based on the transactions that you put in over the course of the month. So if a lot of your transactions are on, say, the 14th and the 15th, it will look at those rates, look at the volume of transactions. And so when it comes up with that average rate for the end of the month, you'll find that it would, if you tried to recalculate it yourself, which I don't suggest doing unless you're really nerdy and have nothing better to do. I have never actually personally done it. So but it does do, you'll find that it will weight it for the 14th and the 15th and come up with that exchange rate at the end of the month. It will also calculate a historic exchange rate. Usually it will just default to whatever day the transaction happened, because transactions to equity accounts are few and far between and usually just happen at one day. So it will grab it does a weighted average, but it ends up being whatever day it is that the transaction happened, just because there aren't many transactions to pull from to do that.
Peggy, I've
So,
got a few questions coming in.
yes.
One on weighted average rate. So is the weighted average rate based on the value of transactions or number of transactions?
Value exchange. The recording's acting weird. You have the ability to go in and edit those exchange rates at month end. If you have a lot of them, you also have the ability to actually import those rates. When you go live with an entity that is, you're bringing in that entity to NetSuite, that entity is a new NetSuite implementation, for example. So you've got history that you're bringing in. You'll need to import those consolidated exchange rates as well, so that your historical information will calculate correctly. That can be imported. There's an import for it. It's pretty easy to do. You can do that on an ongoing basis if you have a lot of entities and you're using an outside service. Or if you only have 1 or 2 entities, you can certainly use those, just handle them specifically on a 1-by-1 basis and edit them at the end of the month. Next slide, please. Are we through the questions there?
Yes.
Okay. Here, this kind of actually talks a little bit about that use case that was brought up earlier. It does permit you to process transactions in foreign currencies. Caveat, the customer and the vendors need to be set up with that currency available. There is a spot in the customer and the vendor record to set that up. As such, it will automatically book the transaction in the functional currency using the rate of the day. Now, you can override that rate both on the vendor bill customer invoice transaction and at the time of receipt of payment or sending a payment out to a vendor. This might be appropriate, for example, if you have a vendor that or a customer that pays you, they pay you in the currency, but you don't have a bank account for that particular currency. And so when you put it into your main bank account, which you can do if the bank account is in the functional currency of the entity, but you will need to override the exchange rate because the bank is not going to give you the published rate. They need to make their cut and they are going to go in and change the rate. So when you receive that amount, the nice thing is it is going to book the realized gain or loss for you. What you might see it doing is it will book the realized gain or loss, and it might have a little bit of a rounding difference, which will go in. You might see kind of two entries go in. This will explain it for people who have seen this before, seen this penny or two of a rounding difference. That's because when you translate, it might not come out exactly, and it needs to do something with the extra penny that's sitting there in your functional currency. And so it's going to basically, it's going to make sure that it completely zeroes out, assuming it's paid in full. It's going to assume that if it's paid in full, it is going to clear out the entirety of the amount due. Let's say it's a customer invoice. It's going to clear out the entirety of the amount due in both the functional and the foreign currency amount. That's really important so you don't get pennies. Additionally, at the end of the month, it's going to look at your AP and AR and any other accounts that you have designated that it's going to revalue. And it is going to say, okay, in these accounts, I have these items that are denominated in a currency that is not my functional currency. So now I'm going to go in, I'm going to calculate between the time that I booked this transaction at the rate of the day at the transaction and the rate of month end. I'm going to figure out what my difference is. And I am going to calculate the unrealized gain and loss on that. Couple of caveats here. Very important things to note. If you have a transaction that is in currency X, do not try to settle that transaction in currency Y. I see that happening a lot of times with intercompanies, much less with customer invoices and vendor bills, but it happens sometimes. But you need to actually post the payment or receipt in the same currency as the base transaction. Otherwise, what happens is you can see your functional currency balance going to zero, but your transactional currency balance does not, which means at the end of the month, it's going to keep trying to revalue that foreign currency amount, even though the invoice or the transaction has been paid. This can get really ugly. I had a situation once where it was an intercompany, so people weren't really paying attention to it. And the company A was billing company B in dollars. Company B was trying to settle in pounds. What was happening was because there were pounds coming in and they were booking them as pounds and not offsetting them as dollars, the system was looking at it and saying, oh, I've got all of these transactions in pounds that are not settled. I need to revalue this. So I had an intercompany amount that was a couple $100,000 USD on the parent, but it was trying to revalue amounts in the millions in pounds on the parent. Don't do that. So it's it is a slight, somewhat of a limitation in NetSuite. You cannot settle a transaction in a currency other than the currency that it was created in. So that is very, very important. Any questions on handling foreign currency transactions? This seems to be where people get flummoxed.
There's one around paying a transaction
Yes.
that is in a different currency than the
Mhm.
transaction was booked in. How does
Yeah, so that's the hard part. So what you have to do at that point is you'll need to take that amount that you received and translate it. You'll have to post the receipt in the currency. So let's say it's a customer invoice. You'll have to post it in that original currency of the customer invoice, and if it came into the bank in a different currency, what you'll have to do is you'll just have to treat it and book it natively as the currency that the transaction was done in. Example, I have a customer invoice that was $100. They sent me 80 euros. The bank translated it into $110. We can only dream. So I received the functional equivalent of 110 US dollars. I need to book that payment not in euros because I can't apply it against that invoice. I need to book it in dollars with the equivalent that the bank brought in dollars.
We did have
Uh,
one other question come
yeah.
in,
Mhm.
Peggy.
Yeah.
It's around how do we clear currency variances? How is that handled?
So, okay, I'm gonna need a little bit of so currency variances. If there's a currency variance, what's gonna happen is the system's gonna automatically post it, and if this doesn't answer the question, let me know. The system is going to automatically post that currency variance. So, like, for example, I issue a customer invoice for 80 euros, I book it as $100. They send me the 80 euros 30 days later, it comes in as $105. So what the system is going to do is it is going to relieve accounts receivable for the $100. It's going to put the cash in at 110 or $105, the equivalent, assuming I have a Euro bank account. It's going to put it in at 105 US dollars. And that difference, that $5, which happens to be a gain at this point, is going to go to the realized gain account, which is an account that lives below the line on your income statement. So the realized and unrealized FX gains and losses live in the other income and expense section of your income statement. So that is how it handles the difference. It's going to put it in the unreal or in the realized gain or loss that basically says, okay, you've cleared the transaction now. And the remaining, basically what ends up happening is the remaining balance in your AR is zero. You've increased your bank account by by the equivalent of 105 US dollars or 80 euros. And then that $5 difference that you've cleared out of a AR ends up below the line on the income statement. Hopefully that answers the question. If that does not answer the question, let me know and, elucidate it or just, elaborate in the Q&A section. Okay, next slide, please. We're going to talk about CTA. We love CTA, right? Everybody loves CTA. No, everybody doesn't love CTA. Again, CTA, people will come and ask, so this is a really big number. How do I fix it? There's no fixing it. It is what it is, unfortunately. But the good news is that it doesn't impact P&L. The bad news is you cannot hedge against it. So I didn't talk about hedging. I'm going to talk really briefly about hedging. Hedging is something that you do when you have a lot of foreign exchange exposure and want to limit the amount of exposure that you have and basically try to manage the P&L side that you get from transactions. Remember, CTA is not transaction generated. It is generated by the fact that I translate my balance sheet using the rate at the end of the month. I translate my income statement using the average rate for the month. I translate my equity section, including retained earnings, at a historical rate. So retained earnings, for example, is month one plus month two plus month three, et cetera, for, until the very beginning of time. So there's nothing I can do about that equity section of the balance sheet. I can't hedge against it. There's there's nothing I can do. It is what it is. Now, sometimes auditors will come and ask about it. There are a couple things in NetSuite that you can give them that I'll talk about actually on the next slide. And I'll also talk about easier ways to give them this information. But sometimes auditors who don't necessarily have a good understanding of where CTA comes from. You get this, you get it with an associate or a senior a lot who are on your account who haven't really worked with this before, and it'll come up and they'll go, "Oh, there's a big flux here between this year and last year." Yeah, the dollar last year for the euro was at 105. Now it's a 115. So things like that. But there are easy ways to, there are reports that the system will give you that will justify where these differences are coming from.
Hey,
Next slide, please.
we had
Oh, yeah.
one
Was there
more
a question?
question. This one,
Mhm.
you're gonna have to give me a second to read through it, and it might be a combination of technical and process. But
Shoot.
the question is, a client card, I assume that means a client rate card in NetSuite, can have multiple currencies. So does
Yes.
a vendor card,
Mhm.
but not a project card. So the question is, why is that? And then the separate question is, doesn't the fact that the project can only have one currency limit how NetSuite users create invoices to clients?
Wow. That's quite the question.
It's a
Okay.
great question.
So it is a great question. You should still be able to invoice in multiple currencies on one project, even if the project itself is denominated in a single currency for things like project billing, things like that. But it requires some intersection. It requires basically that you intercede with it to do the billing. I don't know why projects don't allow for multi-currency billing. I don't have a good answer on that. Because yes, as is correctly pointed out, you can, if you set it up, you can bill a customer in multiple currencies. But if you're doing, say, progress billing or even T&M on a project, it's expecting you to bill in a specific currency. I don't have a good answer for it other than a bunch of manual intervention.
Yeah, there's probably an opportunity to look at more of a process side of things here.
Yes,
How your clients want to receive invoices. Do they truly want multiple currencies on a single invoice? Should
right,
these be separate invoices, maybe consolidated onto a single invoice, but maybe separate projects? But that has to do with your business process and what's going
right.
to streamline things on the back end while also giving your client the right information and from a currency perspective. So there's probably more to drill into there.
And from a T&M perspective, it'll want to bill, even if, so I get a vendor invoice that I'm passing along that's in pounds, but my project is in dollars and billing in dollars, it's going to try to pull that in to the project in dollars and rebill in that currency. Okay. Port consolidation. So I talked about CTA. There's nothing you can do about it. CTAE, I had mentioned as well. It's the canary in the coal mine. If it's large, it means your intercompanies are probably out of balance. If it's small and you have P&L, it's a natural side effect. So I'm going to talk about that P&L CTA element for a minute so that people understand. So basically, let's think about it. I'm company A. I bill company B. Company A, I'm a dollar entity. So I bill company B that's a euro entity for management fees. On company A, I bill them for $1,000. Company B, when they receive that $1,000 invoice, it gets translated at the rate of the day, which is 800 euros at that point. At the end of the month, that 800 euros is going to get translated at the average rate because it's a P&L item. So it's going to translate back for consolidation as $1,002. Keep in mind that the amount I'm eliminating on the parent company is 1,000. So when I eliminate, it's going to eliminate in the consolidating reporting currency, which is the US dollar. I have got a $2 difference that I am now going to stick into CTAE. So I'm always going to have a little bit of noise with intercompany transactions that are done between two entities whose functional currency is not the same. Now, when I eliminate that $1,000 on the balance sheet side, what's happened is I've got the $1,000 on the parent. On the child, I've got $1,000 that translated as 800 euros. I revalue that at the end of the month. It's now going to be, say, 805 euros. That is going to translate back to $1,000. So when I eliminate the $1,000 in that reporting currency, I have $1,000 receivable on the parent, $1,000 payable on the subsidiary. My elimination is 1,000. There is no CTAE. Now, let's say somebody forgot to book the $1,000 on the child subsidiary. Now I've got the parent that says, I have a receivable of 1,000 USD. The subsidiary says, I got nothing. When I try to eliminate using the elimination feature in NetSuite, it's going to go, okay, I got $1,000 to eliminate from the parent. I got nothing to offset it against. I need an entry that balances debits and credits. It's going to go into CTAE. So now I've got $1,000 sitting in CTAE, and there's my canary. Now, the auditors come at the end of the year, and they go, "Oh my God, what's going on with the CTA?" Because there's an associate out there who went, "Oh my God, this is huge. Why did it change so much?" So there is a CTA balance audit report. If you don't like your auditors, give them this. It's really complicated. It's really hard to read. I personally hate it. If you want to be nice, what you can do is you can do a side-by-side balance sheet. So I can go in and it's really easy to do. I take a balance sheet in the local currency. I take the balance sheet as presented by NetSuite in the reporting currency. And then I have a third column where I take the local currency balance sheet. I translate the entirety at the rate at the end of the month, and I compare it to the US dollar balance sheet that NetSuite created. And I just do the mathematical difference. It's should all be in the equity section of the balance sheet. And that way you can show an auditor where it's all coming from. If they want to get into more detail than that, they are welcome to look at the CTA balance audit report. However, most auditors will look at that and go, uh-huh, and be completely happy. Now, I have a slide here that kind of shows examples. On the next slide, please. Shows examples of what this looks like on a transaction or on a subsidiary. So here I have an elimination company and I've got a couple of subsidiaries, foreign subsidiaries. Now note the elimination entity does have a CTAE amount, which tells me that maybe there's an issue, maybe not. It's kind of a large amount compared to retained earnings. So I may have an out of balance somewhere. If it were just a few dollars, I'd go, okay, there's some P&L stuff there. I'm happy. And then these other two subsidiaries, notice there is no CTAE. There should be no CTAE on any company that is not an elimination company. That's very important. There should be no CTA on any company whose functional currency is the reporting currency. Very important. Sometimes historically people have shoved stuff into the CTA account because they're not sure where it should go. That's not where it should go. Set up an OCI account in the equity section if there are adjustments that you need to put in and they may be currency related, but you're not sure where they're supposed to go. They're not supposed to go in CTA. Posting directly to the CTA account is a very bad idea because it will cause the system to yield unexpected results when it tries to calculate CTA otherwise. So you get amounts that you can't. So remember that easy balance sheet that I talked about, the side-by-side balance sheet? It won't work anymore because you have put manual entries into that system account. This is a system account. It should not have manual entries. CTA, never do manual entries, please, please, because you'll regret it in the future. Just trust me on this one. But this is a nice sort of view of CTAE versus CTA and what it should look like. That is basically all I've got on this topic. Open for any questions that I haven't answered.
Okay, we have one. What's the easiest way to explain CTA to an auditor?
The side-by-side balance sheet.
Okay.
Easiest way to explain it to an auditor because it becomes usually it's because they don't quite understand where it's coming from. So you can just do a side by side and say, look, here, remember, retained earnings comes from income statements. Remember, income statements are done at average. That's why there's a bulk of your CTA that's coming there. Here, look, there's another CTA part here on that APIC that we did last year. Remember, APIC's done a historical. That's why you've got the difference. And usually they'll look at it and go, oh, and next.
We have a another question here. It's long, so bear with me.
Sure.
When you have multi-level subsidiary setup with a mix of currencies, for example, entity A is in GBP, which
Mhm.
consolidates into entity B, which is in USD, which then
Mhm.
consolidates in entity C,
Mhm.
which is in Euro, which then
Mhm.
consolidates finally into the top level
Mhm.
entity D, which is USD. Due to this complex consolidation, we see multiple average and historical rates for the same currency under consolidated exchange rates. So
Correct.
we see GBP to USD for entity
Mhm.
A, to entity
Mhm.
B, et cetera, et cetera.
Mhm.
Which do we provide to our external parties when they ask us for month end average and historical rates?
Yeah, fun times. So, first of all, that average rate by entity is correct because when you're consolidating, you're consolidating at different levels, and the assumption is that each of those consolidation levels reflect ownership. So when I have, and this is something actually that I want to point out as important. Sometimes people will set up NetSuite to consolidate not on an accounting ownership basis, but on a management structure. That's not, and so that can give you, so yeah, so theoretically the folks from France report to the UK entity, but the UK entity doesn't consolidate them. So you wouldn't want that set up as an accounting structure because it doesn't reflect consolidation, and you're going to get incorrect consolidation when you do it that way. However, if you consolidate at that level, it is appropriate to calculate that average at that level. So the question being, so what average rate do I use to say, talk to the very top level parent? You're going to end up having to look at that last level of consolidation because that's where the rates are all coming into play. But yes, it cascades.
Hmm.
And so what you'll see, this is an interesting point that I want to talk about as well. On that consolidated exchange table, when you have those rates that cascade, the only rate you are able to edit is that first consolidation rate for any entity. In the example that was pointed out, you have, so for example, initial rate at rate from company A to company B. So euro to pound. And then you have pound to dollar. The pound to dollar rate is extrapolated for that euro entity. So the euro getting to that top dollar, right? The only rate you can actually address is for that entity is the euro to pound rate. You can change that in the system. You cannot change for that entity how it extrapolates the euro to dollar rate. You can change the euro to pound rate. For the pound entity, you can change the pound to dollar rate, but you cannot change the euro to dollar rate because it is indirectly calculated via the pound entity. I hope that answers it.
We got feedback, positive feedback on the answer. So that's great. That was
All right. It's a complicated answer.
it's a complicated topic. That was the last question and
Okay. And
last
we
thing
are
to cover.
at time.
Right at time. I'll just wrap things up here by saying thank you, Peggy, so much for taking us through all the details, addressing all the questions. That was awesome. And then thank you, everybody, for joining. We really appreciate you taking the time. Please reach out with any additional questions. Ultimately, we're here to help. So thank you very much and have a good rest of your day.
Thanks, everyone.